Everybody, it's the Stable Lad coming at you again. I apologize for the delay in the video releases. As I mentioned in my previous video, I had it was a heck of a week. We had the balancer exploit happen. We had stream finance contagion. We had the markets just take an absolute dive into the red, and of course, I had someone really close to me and important to me in my life pass away, and so. It was a heck of a week and needed some time to take a breather from publishing videos, let my brain do a little resting. It's still, my head still doesn't feel quite screwed on correctly, but I'm going to do my best to come back and start to talk about what's going on and just lay the groundwork for some of the changes I'm actually making to my own portfolio that I think are really important. So the first thing I just want to mention here is I don't know that anybody here was affected by this stream finance collapse, but I certainly was. And when I originally saw this, I thought, "Oh, thank God I didn't have any exposure to their stablecoin XUSD in my portfolio. And if I did, my portfolio would have been fine because it would have stayed as a high risk stablecoin. It would have only capped at 2.5% max." Position in this stablecoin. So I thought that was the limit to my exposure, but as many people know, stream finance collapse actually was a far larger contagion in the space than what we had originally thought. They had, for those people that don't know, they had a sort of depeg in their stablecoin, their staked stream XUSD here. It depegged massively and lost 93 million or something like that. But how they were doing it was they claimed that they were a delta neutral strategy that allowed them to give 18% on their stablecoin. We basically saw the same thing happen to Terra Luna a few years ago, but they of course had debt that they had borrowed from tons of different markets throughout all of DeFi, and so because they had all this money borrowed, so many of the vaults that I had actually lent my money to, many of them, not all of them, but many of them that I had lent my money to actually had exposure. So I'm still kind of in the tail end of figuring out what's going to happen with some of that. Some of those positions were covered by insurance, but we'll see if insurance is actually going to pay. Some of those are I'm actually going to recover at least partial amounts of the funds. There's some that have been sort of announced. I think Hyperrhythm over here announced that something like 70% of their vaults are going to be recovered. So I'm still kind of doing the math, and I'm going to do a full post-mortem in my Substack that I'm going to provide for everybody to be free. I'll talk about kind of everything. I'll lay out everything that just sort of happened and all that kind of stuff. And then so you'll if this is just going to be the sort of generalized video, and then if you want the detail, you can go over to the Substack, subscribe if you haven't subscribed, and you can kind of take a look exactly what happened there. But this may sound trite or disingenuous, but this is exactly, when you're building these portfolios, this is the kind of stress tests that you need to make sure that, one, that it's actually working the way it's supposed to be working, and two, if it's not, to make the fixes that you need to make it work exactly the way that you want it to work. And I have several different portfolios personally, and this one is the reason why I'm speaking about it publicly is I thought that this portfolio, the way I had structured it, let's go over here, the way I had structured this portfolio, I thought would actually be the best, and it actually performed probably the worst. It had the most contagion in it. But I don't think it's because of the way the portfolio was structured. I actually think the way the portfolio is structured is actually perfect, where we have basically this essential portfolio structure is 50% goes into low risk, 30% goes into medium risk, and 20% goes into high risk strategies. I'm changing that just slightly. And here's the other important thing: 10% max in low risk positions. So each low risk investment has 10% each medium risk has 5%, and each high risk has 2.5%. I think this actually works perfectly, but I think I sort of failed in that I started to cheat a little bit, and I'm going to explain why in this video. So this video is not going to be about APYs. I'm not going to talk about the macro in this video. I'm not going to talk about where we are in this cycle and all that kind of stuff. So if you're a sort of APY yield hunter, this is not going to be the video for you. This video is going to talk about risk management. It's going to talk about what sort of worked for me and what sort of failed in this recent DeFi event, and how I'm going to change the portfolio to make sure that it does exactly what it's supposed to do, which is to 1, protect capital, and 2, to make money in every single market. So let's get into, without further ado, let's get into what's going on here. So as I mentioned, this contagion was pretty widespread. So it hit Harvest, it hit Silo, Moonwell, Beefy protocol, it hit Euler protocol, and it hit all these different protocols within DeFi, and the contagion was pretty widespread, far more widespread than I thought. And that's making me change a couple different things within the portfolio, and the first is insurance. So I use Open Cover for insurance. They partner with Nexus Mutual, as you can see here, and this is one of the positions I had with Beefy. They cover Base, Optimism, Arbitrum, Ethereum, Avalanche. It's like a great multi-chain covered insurance protocol. And they have paid out insurance before. When Euler lost 200-something million in its hack several years ago, Nexus Mutual covered almost all of that loss, and people recovered most of their money. The problem with insurance, right, is it's not perfect. It's not going to cover everything. We all know that there is, right, like the fine print, right? You can go look here and ask questions. There's fact, there's all these things, and it doesn't cover everything, right? Protect my funds against protocol failures on, and then here's all the detail, right? What's not covered, right? So market price movements, assets that relied upon covered protocol, DPEGs of any assets. So my amounts that I had insured may not be covered. Now, why is this important? Because as you can see here, I did a little bit of cheating. I thought to myself that, we'll go down here to the insurance upgrade. So I thought to myself that, hey, if I'm buying insurance on a medium risk protocol, that would bump it up to a low risk position, which allows me to, 1, label it under my low risk portion of my portfolio, and 2, to size it higher. The problem, if insurance covered every possible scenario, that would make sense. But insurance doesn't cover every possible scenario. And so it doesn't make sense that I would bump it up to low risk. And this is what's great with hindsight, right? We can actually evaluate, do a post-mortem, and see what makes sense and what doesn't make sense. And grading myself, I don't think I did the right thing here on the risk side. So from now on, insurance does not bump it up to low risk. What I'm going to do, and I'm going to upgrade all this, by the way, I'm going to upgrade this StableLad quick reference guide, and I'll make it available to everybody. It will be, by the time I post this video, I'll have upgraded it, updated this, and the link in the video notes, if you haven't gotten this, click the link and it'll lead you to the download, and we can get this quick reference guide, and it will be updated with all the new risk management changes that I'm making. And if you have received this before, then you'll be in the email list, and I will email this copy to everybody so that you have it. Okay, that's the first thing that's going to be changing. What I'm also changing here, just specifically, and it will be in here, is insurance won't allow you to upgrade or downgrade the risk where it falls into the risk side, but it will allow for me to put a little bit more in each of those buckets. So if I am in a medium risk position, and let's say my medium risk position, as I mentioned, is capped at 5%, I'll probably allow 7.5% in that. So I'll allow a tiny bit more exposure because of insurance, and insurance covers most of the things, even though it doesn't cover all the things. But I just more broadly explain that since I'm not allowing for an insurance upgrade anymore, what that does is it makes it harder for me to balance the portfolio, right? As I mentioned before, right here, right, I have to put 50% of the positions in low risk solutions. These are protocols like Aave, Curve, and Uniswap, things like this, things that are a lot more battle tested, a lot more simple. They're less complex. They don't have as many DeFi Legos, as they say, on top of it. So there's less complexity in theirs, and there's less likelihood for a system-wide contagion for affecting these things. What that means is that I can't cheat anymore. I can't use insurance to bump things up that are medium risk into low risk. I have to actually find solutions within these lower risk protocols to place investments in, which means ultimately that APYs will be smaller. But it saves me from myself. It saves me from getting excited about, oh my God, how can I earn higher APYs in this cycle, right? I have to be really strict. If I did this, by the way, I've already kind of done a post-mortem, just broadly speaking, on the portfolio. If I had done this and I had been a little bit more strict with just the placement of this and didn't allow insurance to do this, I would have lost barely anything, right? So the cheat that I did, I definitely, cheaters never prosper. This portfolio didn't prosper as well as it should have because I had cheated, right? Okay, so that's number one. Let's go back here. Number two is, let's go to, well, I don't even really need to show you this, but Euler Finance, I graded as a medium risk protocol. And I think the grade is actually fair. Euler, what they've done is when they got hacked in, I think, whatever it was, a couple of years ago, they learned how to silo. They basically siloed every single market here that they have. So it doesn't matter whether you're on Ethereum or any chain, each one of these vaults are completely siloed, right? So there's no contagion protocol wide. So I've graded this a B, which is a medium risk grade, which means I can I can position each of these vaults as 5%. But what I didn't do is I didn't grade the vaults within them. And not every vault within these things should be graded medium risk. So just because the protocol itself is a medium risk protocol doesn't mean these other vaults within it should be graded medium risk. And while I did due diligence on things like Hyperrhythm, for example, like we can take a look at Hyperrhythm, right? Like, look at this, backed by Hash, backed by Coinbase, backed by Samsung. This is like a really great vault management company. They're out here on Twitter talking about what's going on with anything affected. They're really out there talking about it. They're not hiding away. They're not some like shady financial company. However, they allowed for more exotic lending on this vault, and this is an independently managed vault within Euler. If you looked at the Euler managed vaults, so the Euler DAO managed vaults actually all performed fine with no contagion whatsoever because they weren't more aggressive. And for those, you generally get smaller earning percentages. You get like 9.13% or even less than some of these other ones. Here's the Euler earn one. It's actually paying 16.13%. It had no contagion whatsoever. But Hyperrhythm, Telos, some of these other ones, they did. They had RE7 is another one that has another decent publicly talking about what's going on. Like, I did some research on these guys, but so if I had done the proper research, these should have been rated as high risk. It shouldn't have been medium risk. Just because the Euler protocol is medium risk doesn't mean these are. So that's another thing I'm going to be doing moving forward is more risk on the vaults themselves and more grading on those. So I'm going to go back and talk about and do some deeper dives on Euler and Pendle and some of these other protocols themselves, because these protocols allow for independent managers to come and build out their own structures and their own risk management practices. And if I can't find all the details I'm looking for to grade them as a medium risk, then they're going to be downgraded to higher risk, which would allow me to continue to invest in those, but they would be capped. All right, so those are the main changes I'm making. And as I mentioned, I'm going to be doing, let's go back to there. So I am going to be upgrading this, as I mentioned. The protocol risks, I think, are going to be pretty much the same. I don't think I've changing any of these. but I will upgrade this this entire quick reference guide here. This is going to be completely changed. The insurance portion of the portfolio is going to be completely changed, and then I'm going to do some basic sizing changes here. So right here is the key sort of important, right? Up to 10% position on low risk, medium risk, and as 5%, and high risk is 2.5%. I'm going to be changing these because of two things. I'm going to change the overall high risk portion of my portfolio to something around 15% instead of 20%. And then I'm going to change and make it a little bit harder for myself. So I'm going to cap these at 1.5% instead of 2.5%, so that contagion is held at bay a little bit more. Again, the point of this portfolio, and the reason why I talk about risk management so often, is I want to be able to make money in any market, and I want to be able to sleep at night. I want to be able to have a death in the family and not have to worry about my portfolio on top of it, right? I want to be able to take a vacation with my kids and not have to worry about my portfolio, so that I can actually like set my feet up and relax and hang out with my kids. And that's the point of this portfolio, is to make cash flow, steady cash flow, while managing my risk appropriately. So I'm going to be changing all these just a little bit. And again, I will make this available for everybody. So this is a kind of like just a rough general sort of post-mortem of what happened last week. I'm going to continue with the regular videos talking about APYs and macro. In general, I think the market's looking pretty good. We're holding on here. I was worried about an extended government shutdown, but that looks like that's being alleviated. So from a macro perspective, I'm feeling pretty good. But I wanted to share with you all, really the risk management side of things is going to be changing a little bit on this portfolio. I will be doing the deep dive in more detail on Substack. So again, subscribe there if you haven't. And so until next time, we'll get back into the high juicy APYs. We'll get back into macro. We'll get back into where I am market-wise, portfolio-wise, and all that kind of stuff. And I'll update you as I hear about whether I'm covered on the insurance side. But this is a great experience, painful one, but a great experience to make this portfolio even better, to make it so that I can't cheat when markets get hot. And that's exactly why you want to have a strategy to begin with. So you don't FOMO into things, so you don't cheat, and so you don't add extra risk into your portfolio when you don't need to. When the whole point is about cash flowing, you make the rules, you set them, and you make them really strict so that you can't mess it up. So until next time, I'm the Stable Lad. Stay solvent, stay steady, and we'll see you next time. I'm the Stable Lad, and if you like today's video, please hit that subscribe button. Every week I break down what's happening in the world of stablecoins and why it matters, clearly, calmly, and without the hype. This channel is for educational purposes. It is not meant to be financial advice, so always do your own research and manage your risk wisely.